Okay, I'd like to call to order the special board meeting of April 29th. And with that, Sherry or Michael, legal public statement.
For the record, I want to note that this is a special called meeting of the Board of Trustees of the Kentucky Retirement Systems. This meeting is being held at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road, Frankfort, Kentucky, and by video and telephonic conference, and is being broadcast to the public by Facebook pursuant to Kentucky Revised Statutes, Section 61.826. I ask if you are speaking and are not appearing by video, please identify yourself before talking. In the event the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to another date.
Thank you very much, Michael. And Sherry, roll call.
Yes, ma'am. Ms. Hampton,
Here.
Mr. Atkins,
Here.
Ms. Bova,
Here.
Ms. Eves,
Here.
Mr. Lane,
Here.
Dr. Miller, Mr. Piercy,
Here.
Mr. Summers,
I'm here.
and Ms. Thompson. Thank you.
Okay, thank you very much, Sherry. Sherry, is there any public comment?
No, ma'am, no public comment.
Okay, thank you very much. Okay, so then the next we have Pruitt to discuss the real return investment recommendation.
I believe that's correct. The investment committee met earlier today and unanimously approved this recommendation. And I'll just make some brief comments. It is has been thoroughly vetted in a number of ways. One, we have been investors with this with Kayne Anderson for 10 years or so, and have most recently last fall invested a continuation vehicle of one of the funds we were in to be included in our portfolio. We also had a reference given of someone that I had previously worked with and have enormous amount of respect for, and in the investment, he's an investment professional, and he also happens to own or be invested to the tune of $1.5 million of his personal money in Kayne Anderson funds. So he is pretty credible there, I think. So I'll turn it over to Steve to go forward with it.
Thank you. Thank you, Pruitt. One page forward there. Thank you, Sherry. Appreciate everyone's time. As I mentioned on the investment committee meeting, we really appreciate the opportunity to present this investment recommendation to the full board, especially on such short notice. And as I mentioned in the investment committee meeting, wanted to thank Sherry and Sandy for their exceptional work. They always do a great job of coordinating these, and especially in tight time frames. So really appreciate their efforts. As Pruitt mentioned, last October, the investment committee approved and the board ratified the recommendation to roll a portion of the plan's investments in the Kayne Anderson Energy Fund 7, which was a 2015 vintage fund. And they rolled that investment into what was the Kraken Resources Continuation Fund. At the time, we noted that we were interested in increasing our investment in the strategy. We think it's really good investment, especially for our real return portfolio. Unfortunately, there wasn't any available capacity at the time, and as the fund was fully subscribed or oversubscribed. So following that approval in October, we continued our due diligence with the Kayne Anderson team, including internal and external legal negotiations, as well as conducting several investor reference calls, one of which Pruitt participated on with Anthony. As I mentioned in the investment committee meeting, several characteristics of the fund and Kayne's strategy make this investment opportunity compelling. Those characteristics include a very differentiated strategy for the space with favorable expected risk-adjusted return and asymmetric upside potential, low return correlation to current real return investments and our broader overall public and private portfolio, which is really important for us in this real return asset class as we source new investments. The strategy's significant distribution yield profile allows the investment to materially de-risk over a short time frame while providing high levels of current income. Another significant benefit for a real return portfolio. We also have a shorter funding window, so a significant portion of the capital we will commit would be called relatively quickly. We think that's pretty unique more broadly for the private asset spaces. We've seen it can take an extended period of time when we commit capital. Obviously it's beneficial to us to get that capital committed, called, and invested quickly. So in this case, we think the window is going to be pretty short. As this slide shows that currently all of the portfolios are right at their target weight for the real return asset class, or slightly underweight, less than 20 basis points on an individual portfolio basis. The current allocations, as noted there on the right, currently include investments in what we have as liquid proxy assets, as prescribed by the IPS. And we've been winding down those investments as capital we have committed with existing managers has been called. If we were to ratify this investment, when one page forward, please, Sherry, we would note that this would allow us to almost fully extinguish the proxy portfolio. So I think it's less than 1% exposure to certain of the proxy asset classes, which is important. Again, those proxies were implemented at the time the change was made to the IPS, which increased the real return asset target. And so we invested in liquid proxy assets that have a similar risk return profile as capital is deployed, as we source new investments, and that capital committed is called. So we're excited to wind down that program and invest with these managers that we find compelling investment opportunities. With that, I'll turn it over to Anthony. Anthony, I think you're muted there.
Yeah, of course. Oh, yeah, of course. Thank you. Sorry, Sherry, if you could just scroll down a little bit to the numbers piece. There you go. So that you can see what Steve was talking about. It was approved to invest in the continuation vehicle for the Kraken investment, which was in Kane Anderson Energy Fund 7, which was in our private equity portfolio from back in 2016. The amount that was in the fund was all we were able to do because it was oversubscribed. But in looking at this, we thought the strategy was pretty interesting. It's something actually we've been following since we did the Kane, the original Kane fund. Because I met Danny, I think in 2016 after the annual meeting that fall, and have just kind of followed the strategy. And obviously, it turns out his decision to change models ended up working out quite well. And we think that it still continues to be attractive, especially as a lot of capital has left the space for various reasons. Folks who had done the old model and lost money, and also folks who have environmental concerns or priorities, then they have that's also led to some less capital in the space. So, which provides more opportunity for the people who are still remaining to provide what's needed, because these are still fuels that we're going to be using for decades, for better or for worse. And so that's so this was one of the first investments in Fund 3, and then there's a lot of visibility into it. They've also committed to 4 Point Energy, which is some assets they bought from Ovintiv, which is a public company, in January. So with all that, like Steve said, it's already about a third called, about half committed, and the team from Kane also successfully exited a couple assets within the past few months, and those teams are looking to work again with Kane. And so if those come to fruition, then most of this fund will already be spoken for in commitments. And those teams will again go out to find attractive assets with Kane, and that are, again, are hopefully producing, sending cash flow back regularly to investors, and de-risking the investments. So that's what we found really attractive and why we think it's a good fit for our real assets portfolio. They also hedge heavily, so 70 to 80% of production hedged out on a rolling basis, 3 to 5 years. So obviously commodity price risk is a pretty important one in an oil and gas investment, and so they're cognizant of that and trying to manage that. So that's those are some things we found attractive. To follow up with, I think the investment committee asked some other public plans that are involved. We can ask Kane in the interim, and so we can tell you Texas permanent, state of Michigan, state of Utah, Alaska permanent, Texas teachers, as I mentioned, and then a few county plans, San Bernardino, Montgomery, Fresno, and the city of Boston are also public plans that are involved or invested for anyone who is interested. So.
And as Anthony noted in the both his comments as well as in the memo, you know, the change in the Kane Anderson strategy is really what we are interested in. Obviously, we were invested in their prior funds, and you may have noted that those prior funds were part of our private equity portfolio, and that was more, you know, as Anthony said in the investment committee meeting, more venture-like, and those tended to be developments, you know, higher expected returns if they're achieved, certainly higher risk. This change in strategy, which has been very successful for the Kane team and what we're interested in, as the name suggests, it's more of an income base. So obviously it has a distribution yield, significant distribution yield. We get our cash back quickly. And as Anthony mentioned, that de-risks the overall investment, but leaves some potential upside in realization at the end of term, depending on the value of the assets. And as Anthony mentioned, you know, with commodities, obviously we all know the significant volatility in commodities, and an important part of this strategy is that rolling. I think they hedge out 5 years, correct, Anthony? And that's on a rolling basis, 70-80% of the production, which mitigates some of that volatility. So, you know, I think this is a real. We're very constructive on it. It's a good investment for our real return portfolio, and that's why we're bringing this recommendation before the board.
Thank you. Are there any questions? Okay, I have a couple.
Sure.
After this investment related to Kane, what will be the total percentage of this type of asset that we have in their pocket? And do we have some kind of limit in the investment policy that says even in the real assets or you can only have certain amount to a certain company, for lack of better?
Sure. If Sherry, you can go back to the third slide here. So, sorry, one page forward, fully called capital. So if based on the sizing that in the recommendation as well as the anticipated sizing, obviously this is contingent on market value moves and the overall value of the portfolio. But the recommendation here would be about 11%. And this is for the KRS non-hazardous pension as the example portfolio. This would represent about 11% of the overall real return allocation. So it has a small, and again, that's 10% of the overall portfolio. So from an overall size and exposure standpoint, that's, you know, one of the things we look to do in the real return. We've talked about this in the past, that's a very broad asset class. And not necessarily a specifically defined asset class. So we're looking for something that is a well-diversified, robust portfolio, and we think we achieve that with the exposures both on an asset class and a strategy standpoint. The Kraken, as Anthony in his memo identified, the Kraken exposure was relatively small. Again, that was at an older vintage private equity portfolio investment that we had, and I think it was 17 million. That's 17 million roughly across all pension and insurance. So it was a relatively small investment, and that's why at the time we wanted to see if we could get additional capacity, which they weren't able to provide. But so the alternative here is this is the same strategy, just in essentially a different vehicle. In fact, the Kraken is part of a Kraken investment is part of this Fund 3 that we're looking to invest in.
Along that same line, do we have something in the IPS that limits, that puts some control on the amount we can have with one real return type investor?
Yeah.
Okay.
There's limits both at an overall manager level, so across the entire portfolio, as well as specifically within the real return portfolio. Some level of diversification is required that limits the size in one investment.
Okay. And lastly, for questions, I think it's just coming out of the various lawsuits that we're looking at, or almost over, Michael. Is there something that goes back to you if they do change personnel, that you have the ability to take some action, like get out if they change
Yes.
personnel?
Yes,
Okay.
the key person clause is a pretty important one that's in the limited partnership agreements. So yeah, that is definitely a feature. It's usually involved that the investment period will stop if it's triggered. In this case, it involves the two main people there.
Okay.
So yeah, yes,
Sounds
that's
good. Thank
Mhm.
you.
Yep.
Okay. Does anybody else have any questions?
And Lynn, to your point, I mean, it's a good
Mhm.
question. Anthony, don't quite remember the number, but one of the individuals that we were on with had been there 25
Mm.
years, 26 years or something.
Yes. Yeah, Danny's been there since 1999. So yeah,
So
he's been
it's
there quite a while.
this isn't a revolving door of situation, I don't think.
It's got a good name if it's Denny.
Yeah.
Okay, anything else? Well, Pruitt, do you want to make the motion? Is there to ratify the investment committee recommendation to invest up to 100 million in the Kane Private Energy Income Fund?
Yes, so moved.
Is there a second?
Second.
Thank you, David. Okay, any further discussion? All those in favor?
Aye.
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 Any
Aye.
opposed? The motion is adopted. So thank you again, Sherry, Sandra,
Mhm.
Pruitt, Steve, Anthony, all of you
Mhm.
all that worked so hard to get this to us this quick. And with that, we're adjourned.
All right.
Thank you very much.